Hello, everybody. Hope you are doing fantastic. We finally have some nice weather. People should be jumping for joy now. We're headed into summer, and I'm here again. It means it's the end of the month because you see Eric Guggenheim on the opposite end of the world from me here. But he came back to New Jersey just to talk with us about some market conditions going on right now. Thanks, Eric, for joining us. And I guess we'll get into a little bit. To start off with, with the volatile market, what are some goals that maybe people should be making to, to invest here, whether it's short term or long term?
Well, thanks, Scott, for having me. I hope everybody's safe and healthy and doing their best to enjoy the quarantine time that we have. A lot of people are focusing more so on creating financial wellness for themselves. Trying to save for their retirement, trying to save for their children's education, could be second homes, buying bigger homes
To start off with,
as their families are growing. So there's a lot of different goals that people are planning for right now. And investing now, creating a strategy for that goal, the time frame, your risk tolerance, the things you're comfortable with can lead to long-term success.
okay. What you talked about second homes. When people are looking for second homes, should they be looking for properties in, like for obviously us here at the Jersey Shore, that they can rent out maybe for part of the year or the whole year to pay off that mortgage quicker? What's some good pointers, I guess, with looking for a second home and what you want to look for?
Well, I guess that comes down to whether or not how much time you want to spend in that second home. So, if money's tight, renting it out is always an option to help pay down the mortgage and things like that, or creating it in a way where it doesn't crimp your cash flow, which might take an extra year, 2, 3 to get there, so that you can enjoy it and not worry about what may happen with people renting it.
Yeah.
So I think that comes down to personal preference.
I mean, it was crazy. My wife's family used to rent a place in Ocean City every week, once a week in August every year. And they rented the same house for, I don't know, probably 6 or 7 years because it was right when her and I first met, were the last couple of years. And they went to rent it again, and the people were like, "We're not renting it." So her mom obviously was like, "Well, why not?" They go, "Well, over the last 8 years, we paid off our whole mortgage, so we're keeping it for ourselves now." So it goes to show you that if you get the right house in the right town that calls for the right amount of rent, you could actually, it might not be 8 years. Everybody's different, obviously, what they put down and things like that and what they mortgage. But you ultimately in 8 to 10 years, you could pay off a mortgage and have, I don't know, houses in Ocean City. The average there is probably starting at 450 to 5. You could have 500 grand in equity just by doing that. And then I know the family that owned it, they were using it a lot in the fall and the spring and in the winter.
Yeah. So, I mean, that is definitely a strategy that you're 8, 15 years out from retirement. You want to retire down the shore while you're unable to use it so much. You rent it out, you have them pay it down, and then you have a fully paid off home as you enter into retirement that you can enjoy every summer.
Yeah, and the nice thing about the shore towns is most of them, the taxes are so low that, compared to where we are up here in Camden, Burlington, Boston County, Mercer County, the taxes are so low that it makes it affordable to be able to purchase a second home, and you don't feel like you're paying $1,000 a month towards taxes alone on minimum. So, personally, I actually had somebody call me the other day asking me, "Is this a good time to buy? What do you think?" We had the exact same conversation about, well, do you want to rent it out? Do you want to use it yourself? They're kind of in between as to what they want to do. If they could rent it out for maybe 8 weeks out of the year just to cover even 3/4 of the mortgage for the year, that's a plus to them. So it's a great way to build some equity and build, a retirement nest egg, if you were to say, call it that, down the road, or even somewhere that you can move later on.
Yeah, it actually helps you speed up the equity that you have in the home You could always sell it, buy another one. It leaves you a lot of different options.
Yeah.
So, but like you said, it really comes down to what is the goal? Is the goal something you can enjoy all summer and spend the entire summer down there, or is it creating income and passive income for yourself to help pay off the mortgage?
Yeah, I mean, obviously, being in real estate, I always think second homes are a great idea. But even if I wasn't in real estate, I think that I'd still feel the same way just because of the return you can get. And obviously, with COVID going on, it's a little bit different with the rental market this year because some of the towns are saying that they still won't allow short-term rentals. I believe it was North Wildwood or all of the Wildwoods just came out last week and said that short-term rentals are good to go. I think as of June 1st is what I heard. All the towns are different, so they're all kind of mixing in with me, but that's generally seems to be what's going on at the shores. But with goal planning, one things you and I have talked about is the stock market.
Yeah.
Is right now at the stock market, I always, when I invest my money, I always say it's a long term. I'm going to put it in there. I'm going to let it sit. I think I've had Republic Bank stock now for 3 years. I bought it dirt cheap. It's gone down, but I haven't sold it because I'm just hoping that it will come back at some point. So with the current market, if people are looking to invest in it, should they look at it towards a short-term goal right now because we don't know what's going to happen if we get a second wave of COVID and what's going to happen to the market, or should they be buying and really kind of, I guess, depending on the type of stock, really sticking it out at this point? What's your thoughts?
Well, I think you should have at least a 3-year time frame with any money that you invest of not needing in the next 3 years. I think one of the most important things you should do is really think about the risk that you could be taking in the market and create a investment strategy that aligns with your risk tolerance and your comfort so that you're not freaked out and losing sleep.
Mm-hmm.
And making bad decisions, because unfortunately, emotional decisions, 8 out of 10 of them are usually the wrong ones. History tells us the market always comes back. It's not a question of if, it's usually a question of when. So right now, if we take a look at what's happened since the quarantine and the economic shutdown, the market went down about 35%. It's gained back the majority of that in, I guess we could call it 10 weeks or so. So I'm not quite sure that a second wave is going to create the same amount of volatility we saw the first time. But yeah, it would definitely create some volatility. And I want you to think about it as buying low and selling high. So today, as the market goes down, you're buying more shares, and eventually when it comes back, whether that's a year, 2 years, 5 years from now, that's when you're truly going to see all those shares start making you money.
Mm-hmm. I've been keeping an eye on a lot of tech companies, and now I'm starting to look at hotels, airlines, even though they're not really saying that they can open yet. I think those industries are going to start gearing towards that, and we're going to see those types of stocks and companies, come up. The airlines dropped super, super low, and you're seeing them start to slowly creep up a little bit here and there. So over time, in the next 3-6 months, if they start to open things back up, I would think that you would see the airlines and hotels and hospitality types of stocks and businesses start to increase.
I would hope we start to see that at some point. I think you might see a slower move there, depending on how people feel about getting on an airplane and staying in hotels. I think once we're through the entire part of the coronavirus and it's behind us, and we can put all this behind us and forget about it a little bit, it might be a longer term play.
Yeah.
Than just 1 or 2 years.
Yeah, because like the tech stocks, I've seen them kind of go up, and now they're slowly starting to slip. There was one telehealth company I watched; they were at like $75 a share when Corona started. It went up to think like 98, and now they're slipping in there down to 166 over the past 2 weeks. And I assume that's because they had an influx of revenue when this all started, because now everybody's like, oh, I got it. We got StreamYard, we got WebEx and Zoom. And so all these people jumped on, paid for a year's subscription, the profits went up. Well, now you've got a month and a half, 2 months later, where people don't have to pay for subscriptions. So now their profits are just kind of level playing. They're not generating a ton of new revenue, so their stocks are starting to dip a little bit.
Yeah, I think that also comes into, as we went into this and we're forced to stay at home, you had the stay-at-home stock plays, the Zooms and things like that, because we're not allowed out. Now that the economy is reopening, the anticipation is people want to get out of the house, and those that do are going to leave the house. So now you're starting to see people take profits there and rotate them into stocks that can benefit from the reopening.
Mm-hmm. So I guess depending, we talked a little bit about long-term and what type of stocks you would purchase if you haven't done it already and you're not into it. But I guess depending on what your plans are, like we talked, reference back to goals. If you're 50 years old and looking to retire in 5-10 years, I mean, nobody really retires at 55 anymore, unless if they're, multi-millionaires. I think for the most part, everybody's working into their 60s, and even these days, my father-in-law, my father, my stepfather, they're all 60s, 70s, and they're still working. And they may have retired from one job, but they're working another job because they just don't want to sit home. Yeah. So I guess what they would invest in, maybe compared to you or I that have 15, 20 years. I hope it's less than 20 years for me to retire, but 15, 20 years to retire, we may be willing to invest in some stocks that are a little riskier compared to them who would go for maybe a more conservative type of stock. Is that kind of what you see?
Well, number one, I would definitely make sure you build a diversified portfolio. And yeah, the amount of stocks you have, the risk tolerance that you're willing to take is definitely better the longer time frame you have. Believe it or not, time is money. So it's finding a stock portfolio that is meeting your goals, meeting your objectives, meeting your risk tolerance. And older people may still invest in the Amazons and Apples of the world, but it's probably not going to be as big a percentage as it might be in me and you.
So they're going to be they might be a little bit more diversified with some stocks that are higher risk. Some, their higher risk might be here, and their more secure stocks, a 60-40 type of balance or 70-30 type of balance.
Yeah, and it all depends upon risk tolerance, time frame, the income that you need. But believe it or not, when we look at pretty much 2000 to 2020, investing in an S&P fund or putting all your money in stocks had time periods of outperformance, but a 60-40 portfolio and leaving yourself diversified left you with more money at the end of the day. Yeah. Because when you go down 20%, you need 25% to get back to even. So, as it goes down more, it also needs to make more to get you back to even, where a diversified portfolio, when the stock market's going up, might not make you as much, but it didn't need to because you didn't go down as much either.
Gotcha.
And plus, as you're in bonds, you're reinvesting all the dividends, whether it's from dividend-paying stocks or the interest payments from your bonds. That's helping you build your portfolio as well. Letting that income continue to make you money. So when you add all that in, your total return and ending stock value was actually about 20,000 higher if we based it off 100,000.
Yeah, that's one of the stocks that I bought a couple weeks after COVID started. I just got notice that they're paying out dividends in June, and it's Yeah, it's not a huge amount, but it's at least enough that I can take whatever I make off of those dividends, like you said, and
Mm-hmm.
may not buy that same exact stock, but I can buy something else to
Yeah.
try to diversify, look for some other stuff that maybe has been on a downward trend and starting to trend up, and like
Yeah.
you said, buy low and hold it until it gets a little higher.
Yeah, with the diversified portfolio, you would want to rebalance it back to your target, which is forcing you to sell high and buy low. So you have your target percentages of the optimal risk and reward. So you sell the things that have grown and become more than they're supposed to be in the portfolio, and you buy the things that have gone down. And over time, what's gone up may not be the outperformer in future years. So by doing that, you're keeping your risk and reward optimized, and it's forcing you to sell high and buy low, and that is creating wealth over time.
Gotcha. Well, look, I think we're almost out of time here, so we definitely appreciate you taking time out of your busy schedule to join us. Give some advice, some guidance as to maybe what people should be looking at, because I think with Corona, people's priorities have maybe changed a little bit.
Yes.
And they're definitely looking to invest, if they aren't already, a little bit more. So again, we appreciate your time. If anybody out there has any questions about the stock market, investing, long-term, short-term, retirement, life insurance, Eric is your man to talk to. He's with Ameriprise Financial, and you can actually give him a call anytime, even if it's 3 a.m. He's wide awake working at 856-364-3411. Eric, again, thank you very much for your time, and I look forward to speaking to you next month. I almost said next week, but next month with another market update.
Thanks for having me, and feel free to give me a call. I look forward to helping you figure out whatever questions you have.
Sounds great, and we'll talk to you next month.
Terrific. Thank you, Scott.
See you.
See ya.